Welcome back to the Coin Bureau podcast. Today, I'm joined by Sid Powell, co-founder and CEO of Maple Finance, one of the leading platforms in the on-chain credit and institutional DeFi space. Maple has been through multiple market cycles, from the rapid growth of DeFi lending to the credit stresses of 2022, and has continued to evolve as real-world assets, tokenized treasuries, and institutional on-chain finance have become major narratives across crypto. In this conversation, we're going to unpack how Maple works, what institutional borrowers and lenders actually want from crypto credit markets, how risk management has changed since the last cycle, and where Sid thinks on-chain capital markets are heading next. Sid, thank you so much for joining me today. How are you, man?
My pleasure, Aaron. Thanks for having me on. I'm doing well.
Good. So just so you all know in advance, we were just talking before I hit the record button, but just to be fair, I'm a little bit tender in my voice today. You can hear it a little bit, but it's actually good to know that I'm not by myself because Sid also was sharing that recently on another podcast. You were also not feeling too well, right? So you had to like sneak in
Yeah. I
coughs
had
and
to
sniffles and
had to
stuff. So
sneak in the coughs
yes,
off to the side a couple of weeks ago, but hazard of having a little kid.
yes, absolutely. So before I get into the questions, I really just want to know first, like what really got you excited about cryptocurrency? Like it's one thing for it to be like Bitcoin, but why crypto? And then what brought you down the rabbit hole to get to where you are now at Maple Finance with DeFi and all of that?
Mhm. Yeah, I mean my crypto journey unfortunately didn't begin that early. I wish I could say it began in 2014. I was uh I was a banking graduate back then, and there was this other grad in the same program with me who kept telling me about Bitcoin. And because I was in the banking sector at the time, I kind of viewed it as a scam. And I would listen to Warren Buffett call it rat poison. So unfortunately, my journey didn't begin in 2014. But what got me in was not actually Bitcoin itself. So I started kind of dabbling in Bitcoin and Ethereum in late 2017, early 2018. So the the cycle before we had the big DeFi takeoff in 2020. And what actually got me interested was I was a securitization banker. So what we would do was give really large loans to lending companies. And these were very complex transactions with a lot of modeling on spreadsheets. And so what initially got me interested in crypto was the idea of smart contracts. So the idea that I could do everything that would take me hours and hours and hours over weekends on a spreadsheet, I could program that into the smart contracts, and we could have effectively bonds that would manage themselves. And that was that was the aha moment for me back in 2018.
Mhm.
And fortunately, I'd left banking at the time, so I was no longer as opposed to crypto as what I had been when when I was kind of on the inside of the banking system and kind of viewing it as a competitor. And I was working at a smaller commercial lending company, and so effectively that was where I met my co-founder, and that was where we started trying to work on this idea of could we do tokenized bonds that would manage themselves using smart contracts. And this is a long time ago now. That's about 8 years.
Mm. Wow. Okay. See, having the traditional edge actually is a leg up because I feel like there are a lot of DeFi lending protocols that are just kind of winging it or looking at what DeFi or rather traditional finance does and trying to find a way to get it in. But I love the fact that you're coming from the traditional side, recognizing, wait, crypto actually has a lot of these smart, like you said, smart contracts that already do all of the transactions for you, already do the balancing for you. And then you're just kind of like, oh, well, I know how this works. I just have to like click and manage and
Yeah.
voila.
Well, what a lot of people I think miss is that they'll sometimes say, "Well, this product already exists in traditional finance. Why do you
Mm,
need a crypto version of it?"
mm,
And my retort to that would be, "Yes, it exists, but these are a lot of people who are paid to do this manually, and it only works because a bank has 10,000 people, so they can do it at scale." And
mhm.
otherwise, it would actually be a horribly inefficient process that takes way more time than it should. And ultimately, those costs get passed on to the consumer. They get passed on to the innovative business that wants to borrow, and then that gets passed on to their customers because they have to charge them higher prices to cover the financing cost. And so what I would say is there, there's no central bureau who gets to approve what new technology is worthwhile. You just get to produce it, try and sell it to customers, and if they like it, they buy it. That's
Mm,
ultimately what I think of as the big vision for crypto is that we get a more dynamic and competitive financial system where Jamie Dimon can offer, uh, he can offer institutional debt, and I can offer a tokenized version of that debt through Maple,
mm,
and we compete. If I can do it at a lower price, and if I can pay out higher yield to allocators who give us capital, why shouldn't my product pick up market share? Why shouldn't Maple
mm.
start to win some of that business? And that's,
Yeah,
I think, what a lot of people miss when they say, "Well, this already exists in TradFi." It's like, yeah, no shit. Like a lot of technology already existed. People could go to the shops before Amazon came out. So
yeah, yeah. Well, let's circle back to that though, because I mean, I've learned a lot just by having um a little bit of a dip, and I'm excited to learn more about what Maple Finance is really all about. But for all of our listeners that know Maple by name, but maybe they don't understand the actual business, how would you
mhm,
describe Maple today? Is it a DeFi protocol? Is it an on-chain asset manager? Is it a credit marketplace? How
yeah,
would you describe it?
all good terms that we have used in the past over the years to try and describe what we do. I would say uh, we are closer to an asset manager or an
Mm,
on-chain asset manager with a focus on lending and credit. So we began our journey as a credit protocol in a marketplace where we were trying to be more infrastructure, but over time, we've become more involved in doing direct lending. So underwriting borrowers, onboarding, and approving them. So hence why I would say today Maple is more of an on-chain asset manager with a focus on credit and lending. What does that actually mean if we unpack it? So Maple has around 1.5 billion in loans outstanding. We lend to crypto native companies. Uh, and we take Bitcoin, ETH, Solana, XRP, really, large cap crypto assets as collateral. And so we lend to trading firms, we lend to exchanges, we lend to Bitcoin miners, we lend to digital asset treasuries, we lend to family offices. But you can see these are broadly crypto native companies. They hold some kind of crypto asset and they want to borrow against it. And that's the service we provide to them. We do all of this on chain. We lend in stablecoins. Our loans are tokenized, and uh, and we raise capital through smart contracts. So we do kind of straddle this centralized finance side where we're lending to institutional borrowers with legal documents, but we raise a lot of our capital from DeFi through Syrup USDC and Syrup USDT, which are two. You can think of these as kind of like a wrapped savings product. So you
mm,
a user in DeFi can put in USDC into our lending pool, and then they get back Syrup USDC, which starts to accrue for them about 5% yield. That that they can just passively earn by
mm,
holding what is essentially a slice of all of the loans that we do to institutional borrowers.
mm,
So we've been around for, as I mentioned, over 6 years. We
yeah,
have done around 20 billion in loans. Today, Maple is the second largest global lender to institutions in the crypto space after Tether, and uh, and we have a mission to to really grow tokenized lending and real world assets on chain.
mm. Well, it's really, really interesting that you mentioned you guys been around for 6 years, which is awesome. But that means that you guys have seen
It's like dog years
exactly
on,
what can happen in
steroids.
crypto when things go wrong,
Yeah.
right? So you were around during 2022, which is by far one of the most disastrous and cataclysmic moments in crypto. Yeah, the flash crash in March 2020 because of COVID, yeah, that was pretty bad. But I
Mhm.
mean, Terra Luna collapsing, BlockFi, Celsius, FTX, but you guys made it through.
Mhm.
What do you feel like Maple learned from that period, and how is the model that you have now different compared with the last bear market?
Yeah. It's a good question. So for us, uh, there are a few things that changed. So prior to, prior to the end of 2022, we had been doing more under collateralized lending. Uh, and so that was the first most obvious thing that changed is coming out of 2022. uh, you had the exit of all of the other lenders. So suddenly there was a wide open space or a gap in the market for us to step in and do over collateralized lending. And the market appetite had shifted. People didn't want to lend us money to have us do under collateralized loans. They wanted everything to be collateralized. So we uh, we shifted our business model from doing that to doing over collateralized lending. There was a huge gap in the market, and we had the skill set to underwrite Bitcoin backed loans. And the other thing was uh, you know, it was a very contrarian take at the time that lending was going to survive on chain. So, I remember speaking with a number of commentators, or rather having them speak at me,
Mm.
uh, and tell me that, lending credit didn't belong on chain. Nobody should ever have debt of any kind. And I'm sitting there thinking, yeah, but what are the odds that the literal oldest financial product in the world, a loan, some would say, the origin of money in the first place, if you read that, that book, Debt, the First 5,000 Years, what are the odds that that's not going to have a place in the DeFi ecosystem or the on-chain ecosystem going forward? So anyway, that's one aspect of our business model that changed. And I would say overall, the market is actually far less risky when it comes to lending today than it was in 2022. There's essentially no under collateralized lending taking place anymore. Whereas back then, it was probably 30 to 40% of all lending. The other thing is that collateral is now uh, no longer rehypothecated. So back then, you would pledge your Bitcoin to Celsius or BlockFi or one of the other lenders. There was also Babel out of Asia, and so they would take it. They would have the opportunity to rehypothecate it. They didn't always do that, but now typically what happens is for the larger loans, the Bitcoin or collateral will sit in a tri-party account with a qualified custodian. So there's more and more crypto public companies now who have IPO'd, and they want to be able to show to the market that their collateral is secure. So they prefer sticking it in a BitGo, an Anchorage, a Coinbase custody, a um, Commander, any number of custodians. They want to stick it in an account in their name and be able to show that to their auditors. And so we can do a loan against that collateral. So that's the other thing that I would say. And the collateral is just much tighter. So you're no longer lending against some altcoin with 50 million market cap or a basket of those. Now the lending is very much concentrated among the super large caps. So Bitcoin, ETH, Solana, XRP. So I would say that the lending practices have evolved significantly since 2022. It looks like a totally different
Mm.
world, and it's far less risky in the collateralized lending business now.
Oh, it's really interesting. I mean, I remember my first introduction to DeFi, I think is really similar to most people where you saw some pool where it's like, wow, I can earn what? Like 50% APY on this. I just have to buy some of these coins, stake
Yeah, yeah.
it, and then
And
I
put
earn
it
a yield.
to
This is amazing. I'm making
yeah,
so
yeah,
much money. But then you learn about impermanent loss. You learn about
yeah,
all those other big words that you said before. And it's just like, oh,
yeah. I remember
so
all of those. Olympus, sushi, so
mhm, mhm,
yams,
mhm.
so many.
Yes, too many. And I think that's one of the big problems. I mean, um I'm the main DeFi lending protocols that I know of, honestly, are Sushi, obviously Ethereum, like Aave, which is on Ethereum. But that also is like that's me and that's my experience with DeFi. But I'm curious to actually have you chime in on this too, because who do you feel like is actually using Maple right now? Do you feel like it's mainly crypto native funds or would it be like market makers, institutions, fintechs, or like a mix? Like, what kind of a borrower or lender is the best fit for using Maple?
So we have a two-sided business. I don't like I don't like using the word marketplace because we don't necessarily match up borrowers and lenders in the traditional P2P sense of a
mm,
lending club or an on deck. Uh, Instead, I think one of the innovations of crypto was this kind of peer to pool model. So lenders can go into a
mm,
pool, borrowers can borrow from a pool, and we kind of sit in the middle and intermediate that. Uh, on the borrower side, it's all institutions. So Maple's loan size, our minimum is 10 million, and the maximum we've done is 500 million. Now we lend to some market makers, we lend to prime brokers who will provide margin and trading execution services to their customers. We lend to exchanges, family offices, Bitcoin miners. But what the 10 million minimum does is not because we don't like retail customers. It is, however, that retail operating a retail lending business is very different. So you need credit licenses. It's very different from a regulatory sense,
mm,
and also behaviorally. So you need much more customer service to because you have a customer who may not be as familiar with crypto, and and you need to handhold them, and they could be like quite vocal in complaining. So our minimum loan size is $10 million, so that we only deal with institutional clients. What that means is that at a period of volatility, our book behaves very differently. So Maple's borrowers will typically post collateral on an October 10th type event within 2 to 3 hours, whereas retail will allow themselves to get liquidated. And what it means is it's less stressful on those days for us, and we typically don't have to perform liquidations, or we perform very few liquidations. Uh, so that's one aspect. So that's the borrower side of our business. Then when we face lenders, this is we pay out these people. The job to be done that they come to us for is they want to earn yield on stablecoins. They want to do it in a fairly low risk way. They don't want 20%. They don't need 15%. They're trying to get anywhere from 5 to 6%. So something kind of conservative. They still want to beat T bills. If we couldn't beat T bills, they'd just put their money in a money market fund. And and then they want to have pretty good liquidity. They want to be able to get their money back same day or next day. And those customers, it's a much broader mix. So you have, DeFi power users, whales, DeFi retail, offshore. You also have corporate treasuries. We have some venture funds who stick idle cash in while they're waiting to deploy into deals. And our larger customers that are emerging are uh, stablecoins and DeFi protocols. So we have a great relationship with the Sky ecosystem.
mm,
We have a relationship with the Athena ecosystem. We have a good relationship with the Aave and the Morpho ecosystems as well, and Euler. So uh, you have DeFi, what I would call DeFi yield funds, who do looping through Aave or Morpho or Euler. Sometimes they will use our product because we can pay out a higher yield than the cost of borrowing on those protocols. So then it becomes a good relationship for us. We get more AUM. We're able to lend out more. It's good for the customer. They're getting higher yields than they otherwise would. And it's good for Aave and Morpho and Euler because we are helping to bring up the yield that their customers earn on their platform by being able to incorporate this higher yielding collateral. So that's the lender side. The lender side is much, much broader. And over time, what we would like to do is start to bring in and educate traditional finance or TradFi people uh, on this product. I think if you look, when you go in and do investing in traditional finance, fixed income, you can do rated bonds and they'll pay you in the low fours. You can do uh, unrated or below investment grade stuff that might pay you around the kind of 5 to 6 mark. You can do, private credit, and that might be paying you 8 to 10. And but you're always making a trade off on the counterparty risk, the yield, and the liquidity. Private credit pays a lot more. However, higher risk of default and multi-year lockups. It's 3 to 5 years. What I think Bitcoin-backed lending and the type of lending that Maple does, where it's really good, is we can give a yield that beats T bills and it beats most investment grade spreads, but it's very liquid. You can get your money back next day or same day because we typically keep a cash buffer. And most of our loans are kind of open term with a less than 30-day recall period. So I can always ring up, borrow a ball, and ask to have the loan repaid within 30 days. And then I can meet my redemptions within 30 days. Whereas in private credit, they can't do that. Those loans are locked in for 3 to 5 years, and that's why they're getting paid what they are. So I think the
Mm,
Bitcoin-backed lending offers a really nice mix of excellent liquidity, good yield, and very good downside protection. If you compare this with home loan lending,
mhm,
you know, homes typically don't drop 20% in price. That's something that they have over Bitcoin. However, if your borrower on your home loan stops repaying, you have to go through a 6-month foreclosure process to be able to sell the house. Whereas, I can go through it'll take us less than 6 hours to liquidate, you know, hundreds of millions of dollars worth of Bitcoin. So the liquidity on the market is really unparalleled. That's why I think Bitcoin is fantastic collateral, and why I think the financial system is going to, and TradFi investors are going to want more and more of this asset class over time.
So touching on that just a little bit further, there's a lot that crypto offers where, like you said, it's much more liquid, it's much more flexible. There's not that there's more wiggle room, it's just like you said, Bitcoin is just much more liquid than
Mhm.
foreclosing on a house, God forbid. But I imagine that still some institutions are pretty nervous when it comes to even touching on-chain credit, like smart contract risks, regulation, transparency, liquidity,
Mhm.
reputation, things like that. What do you feel like the biggest hurdles are so far when you approach the real, not to say like the big boys, but like institutional grade investors when you're like sharing DeFi and all this stuff? Because we've heard stories. I mean,
Mhm.
we've seen the news. We know what's happened with failed DeFi projects, but just because a project has failed doesn't make it bad inherently. So how do you approach that when you get some nervous institutional tire kickers?
Yeah, yeah. Tire kickers is a good word. Uh, we there's a few different things that come up as button issues for institutional tire kickers these days.
Mm.
Uh, so one is security. So that they read about North Korean hacks every month or so. We've had a few doozies this year between Kelp and Drift,
Mm.
and and they are worried about the AI tooling in the hands of some of these guys. So Anthropic's out there saying that Mythos is gonna crack, essentially crack all security out there. So anyway, so security is a top issue these days. So you have to educate them on how we manage and mitigate the risk of hacks using permissioning on protocols, using monitoring. So that's one element, and I would say that's probably one of the single biggest ones. That's probably a top two. The other one is the risk of the inherent volatility of Bitcoin. Now, for folks in the space, we're kind of used to Bitcoin risk. Bitcoin beta is what drives up the price of the broader market. So we don't necessarily want there to be no beta in Bitcoin, but these folks are worried about what if Bitcoin drops 20% in price in a day? Wouldn't that wipe out all of the collateral that Maple takes against its loans? And so, we have to educate them on how we manage risk. So we have, typically our loans would have a 30% buffer, so 70% LTV. And then we do a margin call level where the borrower gets 24 hours to post. And then above that, if the price kept dropping, we have just a drop dead liquidation level where we start selling the Bitcoin without any additional sort of time to cure. So when I talk with ratings agencies and traditional finance institutions, what they look to, unfortunately, is they look back at March 2020 during the beginning of COVID, and they say, well, Bitcoin
Mm.
dropped about 50% in a day then. And that is probably the single biggest blocker for a lot of traditional finance allocators at the moment is yes, but Bitcoin could drop 50% in a day because it did in 2020. Uh,
So did gold, so did TradFi, but sorry, go ahead.
Yes, yes. Yeah, and so, I think, what we try and point to is, yes, that was then, but since then we have, 6 years of data now where
Mm.
its volatility has been decreasing over time, and the liquidity has gotten much, much better. So, we can be comfortable that we could liquidate billions of dollars of Bitcoin if we had to within our haircut. And and that, our borrowers still sign legal documents, so we have recourse to them, even if we did exhaust that collateral. So those are the biggest things. These people, fixed income investors, care about not losing money. That's kind of like the number one rule. And so they care about security, they care about the collateral volatility. And then they and then the other thing is just general curiosity about, why would you use this? Why would a borrower want to take stable coins? And I think that's where, you really have an opportunity to pique their interest, because we can do loans at 2 a.m. on a Sunday if we really want. We can do For us, it's kind of like the difference between Blockbuster and Netflix. Uh, if I want to do a loan to a Korean hedge fund in traditional finance, I have to go and set up an entity in Korea. I set up a bank account. I have to go through an FX process. It'll take days to settle, uh, similar to Blockbuster. Whereas Netflix, they just needed an email to sign up in Korea and a credit card. Uh, and for us, they literally just need a blockchain wallet, and then we can lend to a hedge fund in Korea. So the marginal cost and the reach of doing this activity on chain and tokenizing it, and the transparency that comes from that, this is the fun part of educating these traditional institutions, and this is where they really do see where the puck is going, and and they get quite excited about it. So I know that was a long-winded answer, but those are
No,
kind of
no,
the key things we talk about with these types of clients.
absolutely. And I think it's important to hear the business side, the institutional side, just because I think it's important for people to hear all the stuff that goes on in the back end. Like me as a retail investor, I just see the numbers, I just see the returns, but I don't really know the underworkings and all the crazy stuff that you guys do in the back end with everything that you said before. So it's impressive. Now, actually, speaking more towards the retail audience, like myself, when listeners see a yield number like ROI or API, APY, whatever, API is something else. I can't remember what that is.
API
That's
is
okay.
uh, API is more of a technical thing. APY or API.
APY. API, I was thinking, yeah, that I'm using crypto too much, using my APIs. But when listeners see a yield number, what should they ask themselves before assuming it's a safe yield number or if it's sustainable or not?
There's no simple question to ask, or rather, I would say there's no simple answer,
Mm,
because uh, it's not it's not as easy as looking at the number and being able to discern whether whether what you're being paid to take is excessive risk, whether it's risk of impermanent loss,
mm,
counterparty credit risk, liquidity risk, cross chain hack risk. Um, so I would say it's most important to ask simple questions. It's kind of like a five whys type exercise. So where does the yield come from? What is the activity that's generating the yield? How do I lose money on this? And you should, for me, what I look for when I talk to people who are offering yield is, I'll ask them, how do I lose money on this? And they should have a pretty straightforward answer. It's when they kind of say, well, you can't lose money on it, that that you should be pretty skeptical. So over the last 18 months, we've seen different types of stable coins that were ostensibly meant to be doing uh, something that was like a low risk delta neutral activity. Some of them, it turns out, were not actually adhering to what they were doing or what they said they were doing, and so you were effectively taking directional risk on assets, or fraud risk. Um, in the case of a couple of the stable coins, and so, I think if I see an excessively high one, like 15%, I instantly get a bit more skeptical. If I'm seeing, 4 to 6 or 4 to 7%, I think I can understand if it's supposed to be coming from credit. If it is coming from credit, like trade finance or uh, invoice factoring or something like that, I want to kind of understand how they mitigate, how they underwrite their counterparties and how they mitigate against fraud risk. Um, And I think also you wanna understand if a lot of it is coming from on-chain, like, yield farming or points farming or, you know, uh, harvesting, altcoins and putting it in new protocols. I think you wanna understand how they underwrite the risk of those new protocols, because that's where you end up with hack risk. A lot of the hacks over the past 24 months have either been new protocols or it's protocols that are doing a heavy proportion of cross-chain business because that's just that bridges just happen to be a natural weak point in from a security architecture perspective. So I know that was kind of a long-winded answer, but I think you should be able to ascertain. You should get a clear answer of like, how do I lose money? Like, what are the risks? What does the yield come from? What kind of risks am I being paid to take? Is it counterparty credit, hack risk, liquidity risk, uh, or FX risk, or credit risk? You're on mute, Aaron.
Thank you. That's a lot of stuff for me to consider as a retail investor. So, is there an easier way? Like, I mean, I'm not saying like I just want to give someone money and make money, but h- okay, in regards to Maple, how do you guys handle that? Like, how do you guys and your yields that you offer to retail, how does that work in terms of me as a retail investor looking to just earn a yield on my profits or something that's more long term?
Uh, Good question. So I would say for retail, and it's worth noting, our products are kind of restricted to retail offshore from the US because it's in the DeFi realm. So if you're using Syrup USDC, uh, the source of the yield is from over collateralized lending for us. So loans against Bitcoin. We can describe how we manage the collateral and ensure that we have a healthy margin of error on liquidating or haircutting the collateral. And so I think some of the proxies you can look at are track record. So how long has the protocol been around without incident? Uh, Volume of business process. So processing billions, it is going to have to have worked out more kinks than if it's processed tens of millions. Uh, then then scale. So you know if you're managing $2 billion, you can't do a really niche you can't do a really niche trading strategy. You just can't deploy. I couldn't deploy $2 billion into prediction markets arbitrage at the moment. Uh, so I have to pick something that's simpler, that works at scale, that has a long history of working to be able to do this at scale. So I think that's the other thing is if you go into a protocol that is providing yield at scale and has been doing so for multiple years, there is going to be inherently a little bit more safety in that because it's going to have been through a cycle. It it has a simple enough strategy that it can operate at scale and if they can kind of describe it in simple terms and how they manage the risk. So that's what we found, like with Syrup USDC. People understand Bitcoin backed loans or ETH backed or Solana backed loans. They understand that concept. We've been operating for multiple years now, so we've had the over collateralized product since mid 2023, and we've been doing lending overall since 2021 and before that in traditional finance. And, the protocol now operates at about 4 billion AUM, processed 20 billion in loans. So we have all of those elements I discussed. We have track record. We've been through multiple cycles. It operates at scale and it's a concept that people can understand. I'm not doing janky cross-chain arbitrage on, brand new protocols that launched 3 months ago.
Dude, I don't know. I think janky cross-chain arbitrage is a very spicy pool that you guys should consider opening up. Maybe just like
And
people
to be
with like
clear,
a Mexican hat or something like that, a sombrero.
spicy maple. Um, to be clear, I'm not. I'm not poo pooing those strategies, but I think anyone who goes into it should be very clear. I'm going into cross chain arbitrage strategies. This is what the protocol does that I put my money into. I'm getting paid 15%, and I understand I'm getting paid 15% because they're doing something that's much riskier and carries a higher risk of loss, and that's why I'm getting compensated this extra amount.
Yeah,
I think it's problematic when they say it's 15% risk free, or they misrepresent the risk of loss there.
yeah. Well, coming back to thank you. And I love all these I love all these long-winded answers. This is fantastic because it not only gives you a chance to shine, but it also gives me a chance to just let you talk. I mean, I want to hear what you have to say too. So, by the way, if you guys are watching up to this point and you haven't even liked or subscribed to this video, shame, shame, shame on you. Like the video, subscribe if you haven't, okay? And if you want to see more of this stuff, let us know in the comments down below. Okay, we're talking about DeFi. DeFi should, in my mind, even though it's decentralized finance, it should be hand in hand as well with transparency.
Mhm.
Um, so when we're talking about transparency, we're talking about credit, borrowing, lending. Um, it's a little bit of a murky area, I would imagine, especially for crypto, and whether you think crypto has a nice sparkly name or if you think it's it's a terrible protocol like, oh my gosh, that's okay, it doesn't matter who her name is. It's like a US senator. But essentially, one promise of DeFi, right, is transparency, but credit often requires privacy around borrower details. So
Mhm.
how do you balance transparency with real institutional requirements? Elizabeth
Uh,
Warren, that was the woman's name.
Elizabeth Warren, yeah,
Yeah,
yeah, our
her
biggest
treasure.
fan in the US
Yes.
Senate. So well, I think you can strike the balance. So, as you mentioned, if I'm running a trading shop or an exchange, I don't necessarily want to advertise or telegraph to the world, "Here's my cost of borrowing, and here's how much I'm borrowed." Uh, so how do you enable them to have that kind of privacy that they want whilst still adhering to this, this kind of ethos of transparency on chain? I think you can do it through, just having pseudonymous type borrowing addresses. So what Maple shows is we have a dashboard and you can see this loan is for $100 million. It's collateralized at 70 or 75% loan to value ratio, or put another way, about 150% collateralization. The borrower is paying about 6%, and they are hitting all of their payments. You can see the payments coming through on chain, but at the end of the day, you don't know who controls that wallet. And so I think that gives the DeFi allocator or the DeFi lender or DeFi investor the ability to determine that the loans are real, they're on chain, there is a borrower, the borrower is making their payments, and the borrower has put down collateral that offers pretty good downside protection on the loan. So I think you can do that in the world of pseudonymity, and you don't have to know, provided that borrower is performing, you don't have to know who that is controlling that wallet. And I think that strikes the best balance, because if we had to disclose who all of the borrowers were and what they were paying in interest, we have done that before. That was what we did that in 2021 and 2022. And some of the problems were a couple of things. One, uh, you would get the borrowers then competing with each other. So we'd see a borrower look at its peer and go, they're getting a better interest rate than me. I should be getting that interest rate. And so that is ultimately actually adverse to the lender interest, because then you get bid down on the interest rates. And then the other one was we had a couple of borrowers who were competitors with each other. And then one of them would see the other one, they would start screenshotting their loan and saying, these guys are not going to repay their loan. And so they would try and artificially create FUD around their competitor, and try and induce like a run on the bank. They'd be screen capping, going, we heard that this borrower is in difficulty. They wouldn't disclose that borrower happens to be their major competitor, and so they have every reason to kind of shit talk them online, and it would create all sorts of chaos. It was bad for the borrowers on the platform, it was bad for us, it was bad for the lenders, and it just creates the wrong kind of incentives on using the platform. So I think people can issue public bonds, they can make their name known, they can offer debt, and if they want to do that, they have the option to do that. But as a standard course, we don't do that, because we think, given that these loans are mostly reliant on the collateral quality. So the biggest factor in whether you lose money on the loan is, are they providing Bitcoin, and how much Bitcoin are they providing? If you are actually mostly going to be dependent on the counterparty credit quality. Let's say because the loan is unsecured or under collateralized, then I think there is a much stronger case for I should be able to see who the name of that borrower is, because the biggest factor in whether I'm gonna lose money is the quality of these borrowers. So I want to know, that it's a publicly listed company with audited financials and billions of dollars of equity on the balance sheet versus,
Mm.
you know, a brand new prop trading shop out of, Seychelles that has barely any equity.
Mm. Well, thank you.
But
I had no
that's also
comment.
been one of the issues I've seen. I
Yeah.
mentioned some of the stable coins or quasi stable coins that have come out over the last couple of years, and some of these were purporting to do delta neutral trading. But what they were saying was the delta neutral trading happens on exchanges. It's very complex. Therefore, we can't accurately represent positions. And what we found is in some cases it was fraudulent. So they were taking directional
Oh,
positions. It was a black box, and I think that's where they haven't adhered to this kind of ethos of transparency, and and there are consequences, or there have been consequences to that. So I do think
yeah.
that on-chain transparency is a good thing.
Okay. Well, thinking more about transparency and doing things by the book, and speaking about Elizabeth Warren, let's pivot over to regulation because that's a pretty
Mhm.
hot topic right now. How do you see the regulatory environment evolving for on chain credit and tokenized yield products over the next few years? Not necessarily this year, but over time.
Uh, I think this year the big thing on everyone's mind is the Clarity Act. If that comes
Yeah.
through in the US and gets passed, I think it will be beneficial to to the global crypto industry, because a lot of countries are, they have their finger on the button, ready to approve and adopt a similar regulatory framework to whatever the US puts in place. So they're kind of looking to follow the US's lead, have the US do the heavy lifting on working out the issues and engaging with industry, and trying to strike the right balance. And then other countries will essentially copy paste that legal framework, whether it's Australia or some of the Anglosphere and Commonwealth countries, or or other parts. Europe has kind of already made its bed with Mika, but there are a number of other countries who are kind of waiting to see what happens with Clarity. So, but over time, I think the general principles on which it will evolve will be, uh, there will need to be disclosure of conflicts of interest, which is important. There will need to be disclosure of, the rough kind of financial positions of token projects and token treasuries, and people who are raising money through token issuance, so that you don't have, somebody raises 10 million bucks and starts flying private, using the raised funds, or putting it into a black box and losing customer funds. So I think transparency, disclosure of conflicts of interest, basic financial disclosures, and then some kind of, this is the really important one, some kind of legal rights attached to users of DeFi protocols or holders of tokens. And I think this is the biggest gap at the moment. When I go talk with uh, um, an institutional investor and they look at, potentially buying the syrup token, one of the issues they have is it's very hard to give them formal legal rights associated with the token, because there is unclear securities law around tokens. Where do they sit? Are they securities? Are they commodities? Um, and uh, and uh, and so being able to attach certain legal rights or just explicit legal rights to them, I think will introduce much more institutional adoption, and it will ultimately make it easier and cheaper to kind of to raise capital through tokens and through DeFi. I think capital markets have largely become kind of sclerotic when it comes to raising capital. You can see there are fewer and fewer companies going public than ever before, because it costs you a fortune. It's entirely impractical, the number of you know regulatory filings you have to do, and the kind of cost, the administrative cost of being public. You can't do that unless you are, billions of dollars in market cap, and have a team of 100 compliance people. And so I think we do, you know, uh, developed countries do need to kind of modernize that framework, so that so the capital formation is easier and more companies want to go public. I think that's been a huge problem. Same in the banking sector. Between 2010 and 2020, there were essentially no new banking charters granted, and so we're actually
Mm.
stopping competition, and the lack of competition has a deleterious effect on consumers. They have to pay more. The costs get passed on to consumers at the end of the day.
Mm. Mm. I mean, I'm I'm looking at the whole Clarity Act personally as a trader as a long-term win, but basically a short-term nothing burger.
Mhm.
It feels like people on X, or as we love to affectionately call it, crypto Twitter, have been looking at anything and everything to be the savior of this bear market, and people thinking, well, once Clarity gets passed, it's going to launch everything up to like $1 million. Where long term, I think it's a definite bonus. I think it's a big win for crypto. But in the short term, I don't really see it being like taking having that big of an impact directly on crypto. I still feel like it's going to take ages for things to really get ironed out. And also for those other countries that are on the sidelines, just watching the US going, okay, are they really going to do it? Now that it's
Mhm.
passed, are they really going to like,
Yeah.
uh, yeah. Well, you mentioned stablecoins. Can we talk about that a little bit? And also like tokenized assets. So in regards to Maple's long-term vision, like, and in retail in general and in crypto, we are seeing renewed interest in stablecoins, tokenized assets, yield-bearing crypto products, all that fun stuff. Where do you think on-chain credit fits into this next market cycle, specifically for Maple?
On-chain credit. So I think on-chain credit is one of the few sectors within crypto that has found very evident product market fit, with the others being prediction markets, perps, stablecoins,
Mm.
um, and tokenization. So uh, my take. So on-chain credit is at its initial wedge. We are doing crypto-backed loans. We're doing Bitcoin-backed loans, ETH, Solana, XRP. Uh, this is the initial wedge, and it allows us to prove out issuing loans in stablecoins, tokenizing the loans, raising capital on chain to do the lending. And the next stage that it will go through will be loans. So it'll be capitalizing on the tailwind of tokenization of assets. So I can lend against Bitcoin, but I could also lend against tokenized Nvidia. I could lend against tokenized ETFs and other funds. Um, and then, soon you will have things like tokenized real estate. But broadly, the trend of more tokenization of assets means more collateral to lend against. The other trend of increasing stablecoin issuance means I just have more inventory to lend out. I can do vastly more lending when stablecoin market cap is 1 trillion versus 300 billion where it is today. And, looking back in time versus when it was 50 billion in stablecoins outstanding, because that's the medium in which we lend. So, a couple of things I expect to see. So I think you'll start to see loans against tokenized equities, whether it's Nvidia or Circle or SpaceX or Anthropic. I think you will also see uh, more forms of tokenized private credit, where a lender, I'm in discussion with a number of the other kind of on-chain lenders at the moment. They're looking at lending against crypto credit cards. They're looking at lending against um, personal loans, small business loans. So I think you'll start to see crypto lending encroach on what has up until now been the kind of the territory of the big private credit shops. So Ares, KKR, Apollo, Blackstone, Victory Park, Blue Owl. These guys are soon going to find themselves competing on price and size and terms with on-chain lenders. And I think this is the natural arc of the innovator's dilemma. So, crypto backed lending, I've been told numerous times by the big private credit shops, was not attractive for them enough to look at. It was too small, too risky. And so that's where we got our start. And the innovator's dilemma is that then you go vertically up the stack. You then start to do, securitization warehouses or credit card programs, and then invoice, invoice finance, and then eventually you'll see billion-dollar project finance deals done on chain. Already, we've seen the USDAI guys are doing GPU finance and data center finance. So uh, the share taken up by crypto and on-chain lending is going to expand. It's going to encroach on that kind of private credit shadow banking sector
Mm.
and take more and more share over time because you can do it at lower cost. You can settle it faster using stablecoins. You can uh, you can distribute globally because a stablecoin is just as easy to send to Korea or Japan as it is to send to New York or Texas.
Mm. That's wild, man. I mean, I didn't even know things were getting that crazy. I mean, I remember first two
Yeah, already we've
tokenized
looked at a
real
bunch
estate.
of
Yeah,
Yeah, already we've looked at a bunch of private credit type deals that 2 years ago would have just been funded by a Victory Park or Wow.
yeah, for sure. So, looking ahead to the future, I mean, I'm still a big believer in the bear market, the 4-year cycle, but
Hmm.
thinking 3 to even 4 years out when we're starting to get to that next all-time high, what do you envision success to look like for Maple 3, 4 years down the road? And what would you want Coin Bureau listeners to understand about where this entire sector is heading over the next 3 to 4 years?
Good question. So uh, I'd paint I'd do a broad brush painting and say I think the growth of the sector is going to be powered by the growth of stablecoins. I think over the next 5 years we'll surpass $1 trillion of stablecoins. We will see uh, at the moment, we're at, I would say, tens of billions of kind of tokenized assets, stripping out stablecoins. That'll pass to 100, 200 billion of tokenized assets. So we have more collateral to lend against, more inventory to lend out in stablecoins. And so I think Bitcoin backed lending and crypto backed lending will continue to grow. But the sector and Maple will diversify and we will have other lending products that we do to institutions. So we will be able to have a less cyclical loan book where, you have October 10, you see a lot of people return their Bitcoin backed loans. Instead, you'll have diversification. So you earn a great yield year round. And, and the other thing I think, so we'll start to be participating in more, private credit or fintech asset backed lending type deals. And so, expanded product set. And then the other thing is, I think we will have traditional investors and institutional allocators come in and they will allocate on chain, and then we will lend that out, uh, lend out those assets on chain. So you start to see more participation from traditional finance in on chain fixed income. And I think that's going to be a huge unlock for the space. So for Maple, we want to be getting to tens of billions of assets under management, and hundreds of millions of ARR as a as an on chain asset manager. So for us, that's the North Star. We are looking to continue to grow and compete with those top private credit and alternative asset management firms. And we want to grow ultimately we want to grow to 100 billion plus AUM and billions of dollars of revenue coming from the loan book.
Hmm. Sid, this has been a crazy deep dive. I did not expect for you to go so in depth, and I'm so glad you did for myself and also for the listeners because I learned a ton and I have a lot of new homework to start doing when it comes to DeFi, obviously, where I can't just decide to invest based off of the number I see, as well
Mhm,
as learning more about the ins and outs of what you guys do at Maple.
mhm.
Before we end today, where's the best place that people that are here on the Coin Bureau podcast listening to you or watching you today, where can they follow you, Maple, and your work?
So if you're interested in finding out more, we have a website, so maple.finance. We're also very active on X, so at Maple Finance, one word. I'm pretty active on X myself, so I'm at Syrup Sid is the handle. So, either head to our website, we have a contact us form there, or follow us on X and you'll get the latest announcements. We do have our quarterly investor call coming up in the first week of July. So anyone who wants a further sort of deep dive into what we do can always join for that, or broadcast.x.
Fantastic. Sid, thank you again so much for your time. I appreciate it, buddy.
Thanks, Aaron. Take care.
All right. You guys have a great day. And don't forget to like, subscribe, leave a comment with what you've taken away from this video. And if you want to see more stuff like this, let us know down below. That's your voting zone. Okay. And until the next time, you know what to do. Stay awesome and stay in the green. Peace.